Have you ever wondered what's really happening inside a lender's mind when they're looking at your mortgage application? Well, today, we're going to pull back that curtain. We're using key ideas straight from the NMLS Safe Exam Study Guide, the test that every single loan originator has to pass. We're going to break down exactly how lenders see your finances. All right, let's get into it. So you fill everything out, you hit that submit button, and then what? It can feel like your entire financial life just got dropped into a mysterious black box. But it's not magic. It's a really structured process called underwriting. And by the end of this, you'll get the core mechanics of how it all works. We're basically going to walk through the underwriter's own checklist. First up, how they prove what you earn. Then we'll look at what debts they actually count against you. After that, we'll cover the simple but absolutely critical math they use. And finally, we're going to decode some of those weird-sounding points and fees. Okay, let's kick things off with the fun part, the money coming in. Lenders need to figure out your true, stable monthly income. And as you're about to see, it's not always as simple as just glancing at your last pay stub. The absolute magic number for any lender is your gross monthly income. That's everything you make before taxes, health insurance, 401k, any of that stuff gets taken out. This is the baseline, the starting point for every single calculation they're about to do. So how does a lender compare someone who gets paid hourly to someone who gets paid biweekly? They have to standardize everything. And they don't just, multiply your weekly pay by 4. They use these really precise formulas you see here. And this is a common trip-up. If you're paid biweekly, they multiply by 26 pay periods, not 24. It's that level of detail that makes sure the whole process is accurate.
But what about income that isn't just a steady year-round paycheck? For seasonal workers, think landscapers or teachers, unemployment can actually count, as long as it's part of a documented 2-year work cycle. For other stuff, like a pension or alimony, there's one simple, powerful test. Is this income likely to continue for at least 3 more years? If the answer is no, they can't count it.
And how do they prove all this? Well, they go straight to the source. You'll probably sign a couple of IRS forms to give them access. The 4506-C, for example, lets the lender get a copy of your tax transcript right from the IRS. It's their way of making sure the numbers you gave them line up with what you told the government. It's all about that documentation. Okay, income is covered. Now let's flip the coin and look at the other side of the ledger, your debts. Lenders have to get a complete picture of your monthly bills to see how much of your income is already spoken for before you even get a mortgage. So what counts? Pretty much any repeating debt. Car loans, student loans, credit cards, you name it. Now for installment debts like a car loan, there's this little 10 payment rule. If you have 10 or more payments left, they count it. If you have 9, they don't. But car leases are different. They are always included no matter what. And with credit cards, if there's no minimum payment on your statement, they'll just use 5% of the balance as your monthly payment.
Student loans. These can be really tricky, especially if you're on a plan that shows a $0 payment. Lenders can't use 0, so they have to apply a formula. And this is a perfect example of how different loan programs have different rules. Fannie Mae uses 1% of your total balance as a pretend payment, but Freddie Mac and FHA use a much friendlier 0.5%. I mean, that one little difference can totally change your debt calculations. So beyond your debts, lenders look at how you pay your bills. We all know about traditional credit, right? The scores from Equifax, Experian, and TransUnion. But what if you don't have a lot of credit history? A thin file, they call it. That's where non-traditional credit can come into play. It's a way to prove you're reliable using payment histories that aren't normally reported. So what does that actually look like? Well, it's things like a solid 12-month history of paying your rent on time, your utility bills, even your childcare payments. This lets a lender build a picture of your financial responsibility, even if you don't have a long history with credit cards or loans.
All right, now we get to the core math of the whole underwriting process. This is where lenders take the loan you're asking for and put it head-to-head with the value of the home you want to buy. It's all about measuring risk, and these ratios are their yardstick. The most basic and important ratio is the loan-to-value, or LTV. It's just the loan amount divided by the property's value. But here's a key detail. Lenders always use the lesser of the purchase price or the appraised value. So if you agree to pay more than what the house appraised for, your LTV is going to be based on that lower appraisal number. Okay, but what happens when there's more than one loan on a property, like a primary mortgage and a home equity loan? That's where combined loan to value, or CLTV, comes in. It's super simple. It just adds all the loan balances together before dividing by the property's value. It gives a total picture of all the debt. And then we have the most forward-looking ratio of all, HCLTV. This one is specifically for when a home equity line of credit, a HELOC, is involved. And the critical point here is that lenders don't use your current HELOC balance. They use the full credit limit of the HELOC in their math. Why? Because you could theoretically go out and max it out tomorrow. This gives them the truest picture of the maximum potential debt on that house. Lastly, let's quickly touch on the language of loan costs. You hear terms like basis points and discount points getting thrown around, but what do they really mean? Let's just demystify them real quick. A basis point, it's just a fancy way of saying 1/100%. That is it. So instead of saying 0.5%, people in finance will just say 50 basis points. It's just a more precise shorthand way to talk about tiny percentages. Just to put it in perspective, one single basis point is just 0.01%. So when you hear someone say 100 basis points, all they're really saying is 1%. It's a really simple conversion once you get it. So then, what about discount points? This is a trade-off. You're basically paying a fee up front to buy down your interest rate for the whole life of the loan. Typically, 1 point, which costs 1% of your total loan amount, will lower your interest rate by about 0.25%. You're paying more now to save on interest later. So there you have it, standardizing income, calculating debt, these key ratios, and the language of fees. It's not a mystery box after all, it's just a process with very clear rules. And now that you've seen the underwriter's checklist, how is this going to change the way you prepare for your next big financial step?